Every Thursday, Freddie Mac releases the results of their primary mortgage market survey, which reveals the most recent movement in the 30-year fixed mortgage rate. Last week, the rate was announced at 3.1%. It was the first time in 3 months that mortgage rates surpassed 3%. In a press release accompanying the survey, Khater, the chief economist at Freddie Mac, said that mortgage rates rose across the loan types this week as the 10-year U.S. Treasury yield reached its highest point since June. The reason Khater mentioned the 10-year Treasury yield is because there has been a very strong relationship between the yield and the 30-year mortgage rate over the last 5 decades. The relationship has also been consistent throughout 2021. The most recent jump in mortgage rates was preceded by a jump in the 10-year Treasury note. So what impacts the yield rate? According to Investopedia, there are a number of economic factors that impact Treasury yields, such as interest rates, inflation, and economic growth. Since there are currently concerns about inflation and economic growth due to the pandemic, the Treasury yield spiked last week. That spike impacted mortgage rates. So what does this mean for you? Khater in the Freddie Mac release mentioned that we expect mortgage rates to continue to rise modestly, which will likely have an impact on home prices, causing them to moderate slightly after increasing over the last year. So Nadia Evangelou, the senior economist and director of forecasting for the National Association of Realtors, also said that consumers shouldn't panic. Keep in mind that even though rates will increase in the following months, these rates will still be historically low. The National Association of Realtors forecasts the 30-year fixed mortgage rate to reach 3.5% by mid-2022. The bottom line is this: forecasting mortgage rates is very difficult. As Mark Fleming, the chief economist at First American, once quipped, he said, the fallacy of economic forecasting is don't ever try to forecast interest rates or, more specifically, if you're a real estate economist, mortgage rates, because you will always inevitably be wrong. That being said, if you're either a first-time home buyer or a current homeowner thinking of moving into a home that better fits your current needs, keep abreast of what's happening with mortgage rates. It very well may impact your decision.